Hey, I'm Michael, and I'm the content lead at Simply Wall Street, where we want to help you think long term, reach your own conclusions, and be lifelong learners. So in this video, we're going to have a look at Netflix, and more specifically, the bullish and bearish cases around the stock. We're also going to go into what narratives actually underlie these expectations, and more importantly, how you can actually build your own narrative and valuation using Simply Wall Street for some help. So let's dive in. Let's just start with a quick overview of the business and its fundamentals. Netflix is a well-known business and most people have a fairly good idea of how it makes money. Just to give you a quick summary though, the platform provides a movie and TV streaming service to consumers for a monthly subscription fee. Monthly plans range from around $3.60 to $19 in different countries for the basic plan, while the premium plans are as high as $27. The global average revenue per user though is around $11.70 per month. Netflix began producing its own content in 2010 and its annual content budget grew to $17 billion by 2020. Now let's have a look at Netflix's current strengths. It has three main ones that we're going to focus on today, and they are its huge scale, its strong expected earnings growth rates, and its unique intellectual property in the form of its own content that's created. Firstly, we're going to focus on the main strength, which is Netflix's huge scale. Its subscriber count has now surpassed 223 million users globally, and it earns annual revenue of $31 billion. The company is now at a point where it should be able to keep its content budget steady at around $17 billion a year, so any future revenue increases should flow through to the bottom line. This is a competitive advantage as very few companies can profitably produce as much new content as Netflix. The likes of Disney and Amazon, of course, can fund their own content too, even if it's unprofitable, but what they're going to do is they use funds from other parts of their businesses, all in the name of user growth in their streaming segments. So that means Netflix is a pure play media business doing this content spending on a much more sustainable and profitable basis thanks to the scale it's now achieved. The second strength is in regards to its future earnings growth, which actually looks quite good. We can see on the Simply Wall Street company report that on average earnings are expected to grow by around 17% per year, which is ahead of the market's 14% expected growth, but that's lower than the entertainment industry's 28% per year. While revenue has grown at 22% per year over the last 5 years, that growth is now slowing down a bit. Netflix barely generated any profits until 2018 because they were focused purely on growing their subscriber base and their revenue to reach the scale they now have. Since then, its spending, which is mostly on content, has increased at a much slower rate than revenue growth. This has led to annual profit growth of more than 35% per year between 2018 and 2021, and the net margin increased to around 15%. Proving that the business model can work. Again, this is the benefit of reaching such huge scale. The content costs per user are lowered as more users get added, with every excess dollar going to the bottom line. Lastly, its unique content is finally becoming a strength after originally being a weakness in the early days. When it was licensing everyone else's content, it was at the mercy of either price increases or the owners of the content not renewing the contract and pulling the content from Netflix entirely. Nowadays though, Netflix has thousands of Netflix originals internationally that are giving the company similar benefits to the established players like Disney, which is basically unique content that users can't find anywhere else. The proof is in the pudding, where it seems like every few months a Netflix original is making waves in the news, and the streaming platform boasts one of the lowest churn rates in the industry. Add to that the fact that these streaming services are a relatively cheap form of entertainment, and the value proposition from a user point of view is pretty compelling. So while they do compete with the likes of Disney and Amazon, who have cheaper basic plans and plenty of unique IP on their own, the value proposition of a Netflix monthly plan is strong when you compare it to the likes of gaming, or going to the cinemas, or even going out to eat for that matter. Now let's talk about some of the risks. The Simply Wall Street company report doesn't identify any immediate red flags in terms of the financials, but Netflix is certainly starting to face some challenges. In particular, competition has intensified and some markets have become saturated. Until a few years ago, Netflix had very few direct competitors and it was able to easily win users from the cable and linear sort of networks. That's all changed more recently with dozens of new streaming services launching around the world. For Netflix, the primary challenges are Disney and Amazon Prime, followed by HBO Max and Hulu, which funnily enough is also owned by Disney. A recent survey from Just Watch showed that Amazon and Disney gained US users during 2022, while Netflix lost market share. This is partly due to all the other options available and partly due to the fact that so many households have a Netflix account. One thing to keep in mind is many households have multiple streaming accounts, so when competitors are gaining users, it doesn't necessarily mean Netflix is actually losing them one for one. Looking at the subscriber numbers from Q4 in 2022, we can actually see that the total memberships in North America are still down year over year, although they did increase in the fourth quarter. As for the European, Middle Eastern, African, and Latin American markets, subscribers increased around 4%. The only region showing real growth is Asia. However, the average revenue per user in the region is falling. This was partly a result of the strong USD in 2022, but even in constant currency terms, revenue per user did fall. Now that we've looked at some of the strengths and weaknesses of the stock, let's have a look at these current valuations and what analysts are expecting from this company and what their narratives are that back up these valuations. As it stands today, the current share price of $365 implies that the market is expecting profits to grow around 24% per year for the next few years. That is, of course, with certain assumptions like the discount rates, years of growth, etc. And you can see them on the left-hand side here. But we're not going to cover them in this video in detail. Just know that as you change them, it will impact the valuation significantly. So let's have a look at the more bullish narrative first and why some analysts might think that 29% per year earnings growth is achievable. The bullish case for Netflix is made up of many catalysts, but three of the main ones we'll cover today are: 1. Successfully cracking down on password sharing to generate new paying users. 2. Successfully launching an ad-supported plan to increase their subscriber count. And 3. Content cost stabilizing and operating leverage being achieved, leading to faster profit growth. Now, the bullish point of view on the first catalyst would assume that Netflix's push to crack down on password sharing doesn't negatively impact subscriber numbers and in fact actually increases paying subscribers and thus revenue. Users who would previously get away with using someone else's login will be pushed towards being a paying subscriber in their own right. The second catalyst here is the outcome of the ad-supported subscriptions. Bullish estimates would assume that there are plenty of people out there who would consider a Netflix plan if it was cheaper, and that type of user is willing to cop some ads for the cheaper price. So the assumption would be that Netflix could acquire them and plenty of them. Then, as the number of subscribers choosing this plan increases, the platform could become more attractive to advertisers, leading to higher revenue per user and lucrative advertising deals. This could lead to a compounding effect where the more ad-supported user plans there are, the more advertisers want to advertise on Netflix, and the more they advertise, the more revenue Netflix makes, the more it can spend on content, the more advertising plans there are, and so on and so on. Now, the third catalyst is controlling costs. If the company can keep costs under control, any small increases in revenue will result in much larger increases in earnings and cash flow. So revenue does not have to increase at historical rates to produce significant earnings growth. If you think these above catalysts are likely and that the narrative they represent is reasonable, then the accompanying 29% earnings growth rate might make sense to you, and therefore the highest $440 price target from the analysts could seem fair. Although that's only about 21% above the current price, so it might not be enough of a margin of safety for you. As for the more bearish narratives out there are again a few catalysts driving that point of view, but we're going to cover the three main ones, and it's essentially the opposite outcome of those same catalysts we just mentioned. So that means the crackdown on password sharing does not generate new users, and therefore revenue does not grow, or at least it doesn't grow as quickly. The next one would be ad-supported plans does not lead to new users subscribing, which means again revenue growth is lower or even flatlines. And the last catalyst would be the content costs continue to increase relative to revenue, and that operating leverage they aim to achieve is not doable, meaning profits don't grow as quickly as expected. The overarching bearish narrative is basically that the industry is now very mature and very competitive, and Netflix won't be able to grow revenue without increasing spending by a proportional amount. That would mean that earnings would be slow or flat, and the company won't be able to grow into the current valuation it holds today. If you believe that this bearish narrative is more likely, then the 11% earnings growth rate might make more sense to you, and your fair value estimate would be a lot lower than the current share price. In this case, the $215 price target from those bearish analysts might make more sense to you, and that price is 62% below the current price, so the stock would seem quite unappealing on that basis. Now, to wrap things up, I just want to remind you that it's necessary to think in a full spectrum of possibilities rather than just a binary good or bad. We've outlined the bullish and bearish cases for Netflix, but these just represent the possible edges of the spectrum rather than all the possible outcomes that could be in the middle. It's entirely possible that some outcomes in the middle occur where say one or two of the three catalysts actually are successful, or some other combination. Not only that, but the degree to which these catalysts are successful or not can vary greatly, so that's worth keeping in mind. So it's important to ask ourselves these next questions. Do I think the password crackdown initiative will be successful? And if so, how many users do I think it could add? And if not, how detrimental do I think it could be to the subscriber count? Then, depending on my answer to that, how do I think it will impact Netflix's revenue? The next question would be, do I think the ad-supported plans will be successful? If so, how many users do I think it could add to their user base? And if not, how many users could it lose? Then, depending on that answer, how do I think it will impact revenue? The last big question to ask yourself is, do I think Netflix can stay on top of its content costs? If so, does this increase Netflix's profit margins? And if not, does this decrease its profit margins? Based on my answer to that, how does this impact its future profit growth? When you consider your answers to these questions above, you'll notice you're starting to formulate your own sort of narrative around the stock, and that can then help inform your valuation of the stock. Your beliefs in the outcomes for these catalysts will help give you an idea of inputs like profit growth estimates, and that will alter your personal valuation of the company. The important thing here is to build your own narrative around what you think is probable, and then build your own valuation and conclusion based on that narrative. If you click on the link in the description, it will take you to the Simply Wall Street report for Netflix, which has a lot of the information we've just covered in this video and more. You can also use the notes section on the company report to start jotting down your ideas for the narrative around the stock. That pretty much wraps up this video for today, but please let us know in the comment section whether you lean more towards the bullish and bearish narratives and why. Remember, think long term, come to your own conclusion, and be a lifelong learner. Thank you so much for watching, and we'll see you next time.